Today's episode is brought to you by Abra. Abra aims to provide individuals and institutions with a secure way to control, manage and grow digital asset wealth from a separately managed account. Abra helps its clients get exposure to crypto and crypto financial products like yield and lending through one full service platform. If you're looking to gain access to additional liquidity, Abra has one of the most competitive loan products in the market. You can borrow against Bitcoin, ETH and Solana at up to 50% loan to value. Rates are in the 4 to 6% APY and are open term. You can continuously draw down against your collateral as the price appreciates. Abra has other strategies to add yield, and their team is happy to help align your portfolio to your risk profile. Reach out today and get a complimentary consult in your portfolio. It's worth seeing if they can help you manage your allocation, reach investment goals, manage risk, and add additional yield. Go to realvision.com/Abra and tell them I sent you. Let's get some facts. 37% of you aren't subscribed to this channel. That's almost 4 out of 10 just freeloading the alpha. So come on, hit subscribe and I promise to keep leveling up the show with the best guests and the juiciest insight. Go on, do it now. Hi, I'm Raoul Pal and welcome to my show, The Journeyman, where we journey to that nexus of understanding between macro, crypto and the exponential age of technology. Now, most of you watching this know that crypto has been difficult in recent times. And really, we want to try and understand what's going on, what it all means, but also learn from somebody who's in the trenches as a hedge fund manager running a large portfolio in crypto. So today we're going to speak to Evgeny from RE7 Capital, and we're going to get a good idea of really what's going on right now and what it means for us. Before we go to the interview, I just want to remind you, today's episode is brought to you by Figure. If you believe Bitcoin in long term, the worst move you can make is selling it just to access liquidity. That's why you should check out Figure. Right now, Figure offers crypto-backed loans at 8.91% interest with a 50% LTV, so you can unlock capital without creating a taxable event or giving up your Bitcoin exposure. Figure's the largest non-bank mortgage lender in the US with over 19 billion unlocked on their lending platform. Now they're letting Bitcoin holders borrow against their Bitcoin instead of selling it. Security matters here. Figure uses decentralized MPC custody, meaning your Bitcoin stays in a segregated wallet, not rehypothecated, not pooled, and not sitting on an exchange balance sheet. They've also rolled out liquidation protection to help borrowers during sharp market drawdowns. And if you're stacking sats and also want yield, Democratized Prime lets you earn up to 8.5% APY, paid hourly, backed by real-world assets, not yield games or token inflation. They also have a $25,000 sweepstake happening until February the 20th. Hold your Bitcoin, unlock liquidity, or put your capital to work. Check out Figure using my link below. Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together. Evgeny, great to see you on Real Vision.
Thank you for having me, Raoul.
Yeah, this should be fun. I'm looking forward to this. So, as ever, I'd love to get your story. How the hell did you get here today? And then we'll talk about what you're up to, and then we'll talk about markets and all the things people want to hear.
Yeah, out of all the stories you usually get here, is probably one of the boring ones. You know, I started TradFi in London about 15 years ago in a hedge fund as an analyst, and then eventually as a kind of junior PM doing equity long short, global macro, which was very exciting. And then I kind of transitioned into banking, spent quite a few years in UBS and Deutsche Bank doing multi-asset portfolio management in the wealth management business. And obviously, you know, the pace of working within, you know, European banks is limited by what you can do. So I started searching for something more intense and dynamic, came across blockchain, which got me quite excited because when I learned about Bitcoin when I first heard about it was probably 2012 and I thought it was a Ponzi scheme, so I ignored it. Then I saw blockchain and I was like, oh my God, it's like you can like rebuild a bank and make it so much better. That's interesting. And then I just started very methodically going to all the meetups, and I was lucky to join an Ethereum meetup where Vitalik was speaking.
When was this?
This would have been 2014, 2015. And I was like, okay, I don't understand anything that he's saying, but this is clearly a genius. So I need to learn and figure it out. So spent, about a year learning, then start investing. Then back when enterprise blockchain was a thing and felt like a legitimate way to earn a living, joined a startup doing supply chain traceability for diamonds and other things. That was a pretty wild and exciting experience. But eventually gravitated back towards markets. So DeFi in 2019, started playing with it personally. And then pretty quickly it became clear that there is something new that can be created, something very unusual when it comes to investment strategies. And then I launched my firm a bit less than 5 years ago. And fast forward to today, haven't slept in like 5 years. Yeah, by the virtue of being a 24/7 addict when it comes to on-chain activity. And now I'm here running a bunch of different strategies, deploying capital on chain.
Why RE7 Capital? Why the name?
That's a great question. So that's a chess reference. It stands for Rook to E7. When making the decision to quit a pretty comfortable banking life and launch something new in the wild in DeFi as a DeFi yield investment firm 5 years ago, felt pretty scary to say the least. So it was kind of a deeply personal choice. And at some point I got blocked because I needed to file paperwork and I didn't have the name of the company. And when I was a kid, I used to do chess professionally. So I started kind of drawing on that as an inspiration. And I remember that there was a story that always inspired me, whereby there has only ever been one chess champion that has ever died undefeated. And I was like, okay, well, let's kind of dig into that. So I started looking through, records of his chess games. And then I kind of thought, well, how did he become the world champion? And then I saw, the record of his game, and his final move in his final game was Rook to E7. And having made that move, he has become the world champion. So I thought, okay, well, that's what I want to inspire towards in my industry, in my domain. And then I also thought that, it sounds pretty cool because you can kind of play with it, and you it's like RE7, reset, rethink, like reset finance, that sort of thing. And that's how it started. And then there was an additional kind of deeply personal connection for me, because when you play chess professionally, you keep like a physical notebook where you record all your moves. And when I was a kid, my dad showed me a notebook that belonged to my great grandfather, who played against that guy, and they scored a tie. I don't think I would even try to play against the world champion. It will be very embarrassing, but a little bit of inspiration doesn't hurt.
So what strategy did you start with when you started building?
Market neutral DeFi yield. And what that means in practice is think of it as a hedge fund, and all it does, it collects dollars, converts these dollars into stable coins, and parks these stable coins somewhere in the blockchain, earning yield. We don't care about the direction of the price in that original product. We don't care about designing a trading strategy. We don't care about treasuries, macro, geopolitics, or whatever else. We care about blockchain platforms not going bust through software attacks and hacks. So my thinking was, I want to run an investment firm in the space, and no one goes into the space to make 15-20% a year. We'll come here, no matter how disciplined we try to be, for much more aggressive P&L. But it was very scary for me to base the business as a foundation on something that's extremely volatile. So I thought it would be great as a foundation to have something that's market neutral, that's very reliable and consistent, and then build on top of that. And in the early days of DeFi, you could have parked your stable coins in pretty simple ways and earn, 30-40% a year. And as I was thinking about it, I was like, okay, it's pretty interesting for two reasons. One, it felt very different from, arbitrage and quant strategies, whereby you're not really trying to exploit market inefficiencies. What you're really doing is the same thing that the Medicis were doing in Florence and JP Morgan has been doing in the US economy. You're stepping in to provide liquidity into the ecosystem. That's what banks do. And in this universe, the role of a bank is outsourced to anyone in the market. So anyone with a wallet can do what we're doing, maybe with less sophistication, but they have access to the same set of opportunities. So that if you can step into the ecosystem very early on, you become a structural player like a banker to the industry in a way, which is pretty cool. And then the other element which I found very exciting was this was the first time in kind of my professional history of looking at pretty much all asset classes that have ever existed, where you can have a structurally different and unique risk return payoff cycle, profile. And I don't mean the asymmetry of returns, I mean the source of risk, right? Our source of risk is a random software platform on the blockchain getting hacked. Now that risk may be high or it may be low, but it's completely uncorrelated from stocks, bonds, BTC, and anything else in the world. So you get paid to take software risk, and I've never seen anything else like it. So I thought this could be an opportunity to create something very new and very different that has never existed before as a risk return payoff profile, and that was the main inspiration.
And how do you then go and measure that risk? How do you know what the risk is of an exchange getting hacked?
So,
or do you just run a diversified basket to assume some default rate?
Well, diversification always helps, but it's not enough. So when I was playing with this back in the day, DeFi was wild, wild west. You're getting 30, 40, 60% a year, and then, every third platform is getting hacked. So great as a hobby, but maybe not very reliable as a product. So what I was thinking is if I can figure out the risk management framework, then I have a product. If I can't figure it out, then it's basically a hobby. So then I started thinking, because, I've never studied software or computer science. I'm, kind of a finance person. So I can now I can use Claude Code, but back then I could have typed hello world and that's pretty much it. So okay, well, I don't understand anything at all. How do I approach it? And then I started thinking, well, what is my risk return profile? I put my stablecoin in DeFi. I earn money every second. And then one day, which could be tomorrow or in 5 seconds or in 5 years, I can get wiped out with one event, i.e. a hack. And I realized it's like selling a put option, which is how credit works, right? You get paid and then one day your counterparty can go bust. So I thought, okay, to a non-financial person, lending sounds like a horrible deal because, I borrow from you, I pay you back with 5% interest or I default. That's not great, right? Minus 100 plus 5. But in reality, what you can do is you can diversify, you can run risk, and you can assign a level of risk rating. So with that, I created a framework where I'm okay, can we actually categorize all vectors of attacks that have ever existed on the blockchain when it comes to hacks? Can we create a checklist and a form which you fill in, and then you say, well, you fill in a form and someone scores 100 out of 100, 50 out of 100, 0 out of 100. Then you say it's, triple A, triple B, triple C, and then you run a very diversified portfolio. So that was the hope and inspiration that the framework like that could work. We even published a paper on this a few years ago, and I'm surprised that no one actually, copycatted that. And I was thinking with the same mindset as a fixed income manager would, where you have an index, investment grade bond index, for example, and the index pays you X, and it has an annual default rate of Y. So that spread is what you earn. So then if you're giving money to an active manager, that spread has to be bigger, right? So the same return, lower default, or whatever other combination of factors. When we started in DeFi, the annual quote-unquote default rate, i.e. HEX, has been double-digit, 10 to 15%. It gradually came down as the industry became safer. So now it's maybe, 2, maybe 3, maybe 5, depending on the year. And we have lost about 20 basis points a year to hacks. So we've been able to push that metric down by 20x plus, whilst delivering double-digit yields, meaning the framework works. And that's how we got to it, because we realized that audit firms who are out there, they're trying to label something as green, right? You're building a platform, you're paying a lot of money to auditors, and you want to communicate to the world that you've been marked as green. But world isn't binary and risk isn't binary. So in our minds, we do our research and we look for red. If we find red, it's out. If it's not red, it's not green, it's yellow. And then there are 50 shades of yellow. And then you diversify accordingly and hopefully you achieve a more sustainable outcome.
And so you're not doing cash and carry arbitrage yourselves. You're lending to DeFi overall.
We start with, in what scenario are we okay to lose money? We are okay to lose money if a DeFi platform is hacked. That's kind of our starting point. Within that, we can do whatever we want as long as we only lose money in that scenario. Meaning, if there is a great platform where I can put my ETH and earn a bunch of yield, I will gladly use my stablecoins to buy ETH. I'll short the perps. I'll earn the cash and carry, whilst also earning yield from the DeFi platform. Or I will make the market between a stable asset and a non-stable asset and run a trading bot that hedges out my impermanent loss and kind of the delta risk. But ultimately, it's all about picking a DeFi platform that gives us a very high yield on a risk-return basis.
And are you finding the market still relatively starved of capital? So the yields are pretty decent, or are we seeing more capital coming in, or have we not seen the institutions and others coming in yet?
Last year alone, there's been over 1,000 new DeFi platforms that went live. I don't think there's been 1,000 new DeFi yield funds that went live. So we exist, our capital is a commodity, and there is a supply-demand profile for that commodity. The DeFi TVL has not really grown since 2021. The number of platforms, however, has. So people are still starved of capital. And I think that's a very structural feature because cost of innovation is basically as close to zero as it gets, right? If you have a laptop and Cloud Code, you can fork any DeFi protocol right now. And with a little bit of venture financing, you can do a lot. But in order for someone to launch a fund, raise money, and provide that liquidity, that's pretty hard, and there are quite a few hurdles out there. So for the foreseeable future, we believe that supply demand will continue to be kind of in the favor of allocators, although yields are highly cyclical. So frankly, what affects our P&L more than demand in variance is the cyclicality, because in the bull market you can buy ETH. Buy a ST, you make 2 or 3%, and then you make additional 20 by shorting. That's it. You don't even need to take any DeFi risk. And in the bear market, you won't make anything. So there is cyclicality to these returns, but all in all, it still feels like a favorable environment.
And do you diversify across blockchains as well?
Absolutely. So we take 3 layers of risk. We're holding an asset. Maybe it's a stable coin, maybe it's something else. So what if the stable coin we're holding is bad? So that's risk number 1. The platform is the second risk, and then the chain itself. And we have had cases where, as in not we, but we as an ecosystem, where chains collapsed, right? Terra, there have been some other chains which are relied on a specific bridge. There was a case with was it Phantom back in the day, where the whole chain relied on a bridge which was governed by multisig. And then allegedly, police raided someone's house in China, and the chain collapsed. Like, we don't want to have that risk.
And so, what's stopping the giant pools of capital, whether it's the banks or whether it's Apollo, coming into the space and kind of crushing the returns? Do they just not have the sophistication, or it's still too small for them? Why has that not happened yet?
It's a process, right? So we have been speaking to institutional allocators for a long, long time, and they're definitely becoming more open-minded and more receptive to this. But it's just a very different world. So before Trump, is it really okay for a large, U.S. institution to deploy capital on chain? Is it worth the risk? Not really. Usually, when we speak to all the usual suspects in the traditional world, what they would be telling us, they would be saying, listen, we run a multi-billion-dollar business. How much can we really deploy on chain, and whatever the number is? The P&L we generate from that is not worth exposing our core business to existential risk. So this is changing now, and they're becoming more open. And some of them prefer to deploy through players like ourselves. Gradually, however, we're clearly seeing a convergence of, CeFi, DeFi, and TradFi, where with a Coinbase app, you want to borrow against your coins. Your request for a loan goes on chain through, different vaults, for example, more for, you source that capital. And then that capital can be provided by the market, by ourselves, or by someone who is a traditional institution. So over time, I think that convergence will definitely happen. And then the question is, does DeFi growth materialize further? And given that nothing has really grown on chain beyond, pump and hype, it's TBD. But they're not quite there yet, and the skill set is not transferable, right? If you've been a brilliant trader at Citadel and you want to launch a clone firm, market making on chain, you'll probably do very well. But if you've been analyzing, Coca-Cola bonds, and now you have to start analyzing, hacking risk, there's probably quite a bit of adjustment.
It's not an easy business for people to get into. What kind of returns does this strategy kind of do versus a traditional fixed income sort of arbitrage strategy? I mean, they use leverage, which is slightly not comparable, but in where does it stack up in the return profiles of hedge funds across asset classes? Is it attractive?
So non-financial advisable, obviously, but the way to think about it is the returns of strategy like this are, like I said, cyclical. So, when I talk to traditional allocators, I tell them that imagine that, I'm running a kiosk at an airport, an FX kiosk, and tomorrow there is, Olympics, and 1 billion people go through me. The day after tomorrow there is COVID, and no one is going through a kiosk. And then on the third day, it's just business as usual, right? So in the bull market, you can get historically, 25 to 30% returns.
That's with no leverage.
Correct.
Yeah.
Then in a humble market, you get, 15-ish. And then if it's, a Lehman moment, depending on how well you do, you can get, 5 to 10. So that's kind of the framework and the way to think about the yield profile of strategies like this.
And people who are running funds, diversified funds who have big drawdowns in this space, that's probably because they're running concentrated risk. So they've got, one large event, the FTX style event, and then that hits them. The idea is to have enough diversification that you don't get hit by a single event.
That's certainly our approach, right? If you think back to the fixed income metaphor, you could absolutely have fixed income managers who are running very concentrated books, and sometimes it goes well, sometimes it goes poorly. Or you can take the different philosophy. Like our philosophy has been that we accept that DeFi is 6 years old. That's frankly nothing, and we've operated for more than 5 years out of those 6 years. So from day one, we've operated with the assumption that there are lots of unknown unknowns. Therefore, we at the very least have to diversify, but more importantly, structurally, when you pour your heart and soul into building a firm, you don't want for it to disappear because, one guy, God knows where, decided to rug an exchange, or something terrible happens to a specific blockchain. So our philosophy has been that no matter what blows up in the world, we want to be at least flat on the year, i.e. in the green. And that starting philosophy sets very hard caps on how we operate.
Interesting. And then you've built other strategies as well now. So that was the start. The foundational start was, let's have a nice kind of yield-looking product that is stable and secure, moves around a bit, but not too much. What came after that?
The second logical thing was us thinking that, well, we operate within the sector and we think as fixed income analysts-ish, and we kind of understand this platform. So let's launch a second strategy that thinks as a long-only small cap equity investor, i.e. a directional fund which goes along altcoins rather than the majors, with an intention to beat the benchmark.
And as a disclaimer, Xpair, my asset management firm, is an investor here, but we're doing it as friends having this chat because Evgeny's a really interesting person. But carry on.
Thank you. Yeah, exactly. So yeah, that was the intention. That at least back in the day, when the market wasn't bleeding every day, that seemed like a good idea. And the thinking was, Bitcoin, stands alone as the story of digital gold. And everything else in our mind is basically a story of software businesses. Or someone is selling you the story that we're the next App Store, we're the next Linux, but making money, and we're the next Robinhood, and so on and so forth. So we thought, well, basically you have an ecosystem of small cap liquid ventures is glamorously called in our space, right? 2 or 3 year old companies which are liquid, i.e., they're still venture stage, but you can hopefully get the same upside as venture funds would, but in liquid fashion. And we timed launch pretty well because my firm went live in 2021, and I was very anxious to not do too much too quickly, and also the market was feeling a bit hot. And we went live pretty shortly after FTX, which was kind of by design, and captured a pretty good run over the last few years. And then obviously last year has been very brutal for everything directionally deployed, but we remain very kind of resolute in our view that these assets are definitely not worth zero, and we believe that we're going I feel that altcoins are going through a massive cleansing exercise where what percent, we have, I don't know, 1 million coins right now, maybe more. 99.9% of them should be worth exactly zero. And that's absolutely fair. And when, I talk to allocators and they tell me, well, 99% of assets should be worth zero, the industry must be broken. And I ask them, imagine if every single startup in Silicon Valley would have been publicly listed on day one.
Yeah, it's horrific.
Just imagine
the P&Ls like that.
Just imagine the drama, the noise, and everything else, and that's kind of what we're experiencing. But it's very clear. You ask, you use a case study of, a company that generates, $500 million a year of free cash flow, uses all of that money to buy back its stock, and has, $2 billion of cash. And you ask TradFi people, how would you value that business? You get pretty high numbers. And, we know that in our space, something like Palm trades at very distressed levels. So that was our second strategy, knowing it's, very volatile, but we're willing to take that volatility in exchange for, asymmetric upside. And that's been our second product.
And so when you're in the liquid space, how are you analyzing stuff? Are you using discounted cash flow style analysis, so equity analysis, or are you using more VC style? Where's the total addressable market? Is it getting network effects? How do you think that through when you're analyzing stuff? So, a quick break in your regular programming. If you're serious about your future, grab my free report called Prepare for 2030. I think you've got 5 years to make as much money as possible, and this guide will help you navigate what's coming. The link is in the description. Download it now.
The reality is that I think it's super hard. And I think it also keeps changing as a function of the market regime. And over there, we have 2 buckets in our portfolio where one of them is we're thinking of something as an established business. And DCF doesn't make any sense in our space because, what I even your rights as a token holder, that's still a little bit questionable in some cases. And you're at the kind of, will of the market. But we look at something, we pay a lot of attention to technicals, because the space trades on technicals. Where are we in the macro cycle? Where are we in the crypto cycle more broadly? Where are the majors trading? Because if let's use a random example, let's say you're bullish, Palm.fund on the back of its fundamentals, but if Solana is crashing through the floor, there's not much you can do, right? So we kind of start top down, and then we merge it bottom up, whereby maybe something looks like, let's say the cycle is great and there is a chart that looks amazing, but fundamentally it's 3 guys, shilling their coin at conferences. That's just not a game we have the energy to play. So we try to look at fundamentals, which frankly is not very hard given that everything is on chain. You look at something like Aave, it's, fundamental KPIs are doing this and the price is doing that. So if you see a business like that and you believe that trajectory is sustainable and the founder and you believe the founder is high quality, then you have these alligator jaws, and at some point they have to close, and as long as you don't use any leverage, then you don't get stopped out on the way. And then there are more speculative things, right? So you look for esoteric small things where you put them in your portfolio with the expectation that they'll be worth exactly zero, because these are venture style bets. But if you're right, it's 50 or 100x. And then you try to manage this in parallel. And we have had our fair share of disappointments as well as quite a big share of wins as well.
So you're kind of running a barbell of concentrated risk where you've got something measurable that's understandable, that has some network effects and is not correctly priced according to your view, taking into account the macro and the cycle and everything else. And then you've got the other side, which is more power law driven, which is like, we'll have a basket of this stuff because, you know, we like the opportunity set. We don't know which ones are going to work, and let's just let it play out.
That's exactly right.
And do you then trade around a lot, or you tend to set it, forget it, or is a combination of the two?
So, our approach has evolved quite a bit. Over the last few years, we spent a lot of time trying to optimize. Let's say there is a category and there are two players in the category. You're holding one, you're seeing the other is starting to outperform, so you try to be smart about it. And, in some market environments, that works very well. And then in a bad market, that works very badly. So we have shifted to a completely different approach where as long as everything is holding structurally, i.e. on a technical level, on a fundamental level, and we have a good line of communication with the team to make sure that there's no, hidden skeletons in the closet, then we'll just keep holding it. And if there is something else that's outrunning it, so be it. Because we came to a conclusion that in this market, which is extremely unforgiving, it's better to be very, very patient and not trade around these things, because you're trading in a very P2P environment, and the odds, like, it's not a sustainable way of delivering P&L.
It's really not easy to run kind of altcoin risk. It's just a very difficult thing, but when it works, it really works, and you have to have a lot of patience because it tends to work in very concentrated periods, potentially generally late stage cycle. Yeah, you can be lucky with some things in the middle. We've had, the hyperliquids, we've had, the SUI did pretty well for a while. We had a bunch of those, but really you need the last part of the cycle to kick in.
Exactly. And, when I was back in my TradFi days, I remember looking at a data point of, if you were long S&P from, let's say, 1980 to whatever it was, like 2015 at the time, and if you would have missed, top 10 days in the market, what's the impact on your P&L? And that was like very, very substantial. So just 10 days out of 30 years. And in crypto, I don't think anyone can capture that. And I remember very well the days in 2020 and 2021 where, if you're not in the market on like specific 3 days, you miss out on half the P&L. So I think it's very important. And I think the main reason why people get stressed out in the space is the sizing issue. Right? I think it's very important to walk into this with your eyes wide open and be very clear about your expected, VAR and level of risk is. Because if someone comes to you and says, this is a trade where you can lose 80% of your money or 10x it, okay, yeah, that's great. You can just size it accordingly. But if people think that, oh my God, I'm going to lever up and like gamble my way into freedom, but that obviously doesn't work.
And do you tend to think of your portfolio in terms of the full cycle? Or do you move around more than that? Or is your mental framework is, we need to capture the full cycle gains of this?
So we think we want to optimize for the least number of actions. So when we're putting on a name, we want to hold it till the end of the cycle.
Yeah.
And then we will
may change your view and take it off.
Exactly. And then we will stop holding it if something breaks, whatever it might be. But our preference is not to overtrade. Because again, like when I think back to my almost 10 years of being in the crypto investing game, time in the market beats timing the market.
I mean, I keep trying to explain this to people endlessly, but they're like, why didn't you get out here and do this? I said, that's not what you do. The actual way to compound gains is do nothing. At a simple, for a retail investor, I'm like, hold a basket of Bitcoin, ETH, and Solana, do nothing. They think they need to, every big drawdown, oh my God, it's gone down 30, 40%. I'm like, it's just noise. What you're trying to do is where you bought it and where you sell it at the end of the cycle.
And I think that's where a structural philosophy comes into play, because we truly think of these things as liquid venture.
Yeah.
Right? So if you're making a venture investment, you at least should be making it with a view that you will never see your money again, unless things work out.
Yeah.
On the liquid side, you have the temptation and the pressure of choice, because every day you're not selling something is equivalent to you buying and re-underwriting that every day.
Yeah.
And it's the same thing we've seen with stocks, obviously, but here it's much more extreme due to insane leverage and volatility and just the kind of the ethos of the space. But all the smartest people I've met in this industry, they've delivered P&L without getting anxiety attacks by being very calm and very patient.
Yeah, I just think FOMO is one of the biggest destroyers of returns. I see it time and time and time again. And, just not doing anything is generally the better way of doing things. So what the fuck is going on in the market? We're recording this on February the 4th. It's a shit show. I mean, you and I caught up in Dubai talking our theories through some of this, which I still think is probably right. But
yeah,
it's still, I mean, I still think it's liquidity related, but who the hell is selling and why?
I think if we knew, then the world would be a different place. But it's really hard, right? Looking back, it's easy to say that October 10th and CZ or whatever broke the market and we're paying the price. Okay, fine. Then what's happening over the last few weeks? Well, maybe it's like you mentioned in one of your posts recently, that US liquidity is going down, having deviated from the global liquidity. So maybe it's that. Maybe it's the shutdown risk. Maybe it's people getting worried about quantum, which I don't think is really the case. And like I've spoken to some TradFi people who are holding IBIT, and they're like, "Oh, what do you mean quantum risk?" Like, I'm sure you guys will figure it out.
Yeah, exactly.
It's honestly, I don't understand it. So the way how we're thinking about it at this point, because I feel the market is beyond understanding right now. You can have conspiracy theories that some exchange went bust on 1010, and now they're like somehow dumping the inventory, but like who knows? And like you just don't know. So we're taking a very different approach where we're just zooming out completely. We're looking at multi-year, multi-cycle kind of charts on BTC, ETH, and Sol in absolute terms and relative terms, and then BTC versus Nasdaq, BTC versus gold. By the way, if you look at BTC versus gold, it's at the bottom of a multi-year channel. So we're looking at those things, and everything is testing its critical levels. So over the last year, I probably said 10 times that this is the bottom. So I will not be saying that ever again. But
yeah, I've been there too.
It's not unreasonable to assume we're closer to the bottom than to a bottomless pit. So therefore, as long as we keep holding these levels, then there is hope that we can have something positive happen this year. And if we just break through these levels, then it's going to be very, very bleak. But what's giving me hope is the market is behaving very differently from, let's say, a year ago. So a year ago, Bitcoin is down 1%, Sol is down 3%, and your average altcoin is down 15%. And then it's very scary to be holding alts because you're just getting destroyed every single day. It's like negative convexity. You get, you pay to wait, which is horrible. But now, firstly, there are some names which are actually doing very well and they're up, even though Bitcoin and everything else is down. But obviously, there's like 2 of them. So, you can't do much with that. But lots of alts are actually not breaking down on a relative basis versus BTC.
That's right. It looks like I use others on TradingView versus Bitcoin or total, and there seems to be some stability or outperformance coming below the surface. It's kind of like how I think about this as well, is it took a while for the Russell 2000 to start performing, and it's the same thing. It's small caps versus the majors. It's the same process, driven mainly by the same business cycle as far as I can tell, and it feels like there's signs of something reversing there.
Yeah, and kind of that's the hope we have, but realistically, like every week we're literally at critical levels, right? I mean, Solana, broke down 100 and is now like at 92 as we speak, which is beyond my understanding. So yeah, I'm curious how you think about it at these levels, because, do we stop loss at some point? Do we just keep holding? That's, I guess, the tricky question. But so far, when you look at, there was a great print on ISM, and, we need good ISM to actually have, what we need to have. I'm not a macro expert, but I don't think that we need to, panic sell on the back of who's going to be the new Fed chair. If anything, it's probably the opposite. So if everything is this cheap and this distressed, why would you sell? And, this is, I think, where interestingly, asset allocation comes in, because if you're already fully invested, you're like, maybe I need to just get out before it goes even further down. But then if you're not invested in the space, this is when you start allocating, because blood is not just on the streets, it's up to your kneecaps. And yeah, quite literally so.
Yeah. I mean, as you know, I use my macro framework, liquidity framework, all of that. And all of that looks great. Yes, we need some more liquidity in the US. The shutdown's just ended. There's still a bit of part of it. There's still a little bit left, but really they've announced the funding. It all looks fine. We've got Besant telling us he wants to hypercharge the economy. Why the ISM is important is because that's economic activity, and that means people have more money and they invest in riskier things. And it's all there. The levels are at key kind of levels. The technicals for me, I use a lot of DMARC indicators, are bloody close, not on the weekly charts, but on the daily charts. But you don't necessarily need the weekly charts to stack up. We've got the potential for this Clarity Act to get through. It looks like they're really fighting to get it through, because don't forget, the crypto crowd were the biggest donors to the Republicans. So they owe them something. So they owe them this. So on a risk reward basis, it feels like it's a good trade. Yeah, I'm fully invested. And, for me, how I play it, because I don't think this is the end of the cycle, because it's not the end of the macro cycle. So that would be weird. So I just don't do anything. And if I get more cash in and I can spare the cash, I just keep adding, because over time, if you think that tomorrow is going to be more digital than today, blockchains will have more value over time. And you don't have to go wildly far out the risk curve to capture any of that. And so therefore, it just doesn't worry me. But it worries everybody else so much about the ups and downs, because I understand people's hopes and dreams are in this whole trade, right? It's a lot more than just an investment.
Well, it's a lifestyle, and it's, like ETH and Solana are lower than where they were 5 years ago. So there are people who bet their, careers and lives on this, ourselves included, and, it's not fun. But what really amazes me is the disconnect that we have between the fundamentals and the price. So we, with my partner, whom we're running this fund with, we ran a very simple exercise. We looked at the last year. We picked what we believe to be quality DeFi platforms, and okay, what's the average growth in revenue over 2025? And it was on average for that basket about 30%. And what is the price performance for that basket? It's roughly minus 50%. So that feels a bit weird. And then, every day you have more stablecoins launching, more people, more banks and traditional institutions using on-chain products, more integrations, more. And yet that doesn't seem to matter. So it's like fundamentals are completely disconnected from the price, which then brings me back to, maybe it was as simple as, October 10th, just structurally breaking something in the market. And maybe it's taking longer than we hope to recover from that. It's just very hard to explain it otherwise.
I had a weird thing happen to me. I was writing Global Macro Investor over the weekend, and a client of mine who's a pretty well-known hedge fund manager sent me an email and said, should I buy the bottom in software stock, in SaaS companies? And I'm like, well, Claude Code, Claude, blah, 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 blah. The answer, that the narrative, right? The market narrative. I said, I'm not sure. Let me go and have a think about it. And if we think the narrative in Bitcoin is 10-10 broke things, blah, 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 then I overlay the charts and they're literally identical. And I'm like, okay, this is telling me both narratives are wrong. And there's another dominant factor that's causing this. So, I spent a bit of time with AI chatting through this and thinking through it, and the answer was US liquidity. And because what had happened, and this is my understanding of this, as US liquidity, because of the complications, everybody's heard me talking about all of that because of the TGA rebuild and no reverse repo and then the shutdown, US liquidity shrunk. These two, SaaS or software and crypto, are the furthest out. They're the longest duration assets of all. So what happens is they get hit because the marginal liquidity is not available. There's still liquidity in the system, which is why NASDAQ's going up, blah, blah, blah. Or NASDAQ stopped going up. But, there's still enough momentum in the market. And then the one key variable that changed a lot was gold. So gold starts going up. It's a big asset, and it sucks in attention and capital. So the marginal assets get hit. And so nothing else makes sense if SaaS stocks and Bitcoin are identical charts. So therefore, it's not an esoteric thing, a single factor individually to those things. It has to be something bigger. So that's what I got to with that, is maybe all of our narratives are wrong. It's explained by there's simply not enough money in the space right now to maintain that. It's the same if you think through the altcoin space. There's not enough money for the million altcoins for them all to run. So what you end up with is some runners and a whole bunch of stuff that doesn't ever perform. And so that's because there's not enough liquidity. If you put $1 trillion of liquidity into Bitcoin, into crypto tomorrow, everything goes up because then there's enough liquidity. It's as simple as that, right?
And what needs to happen for that US liquidity to come back and, become the marginal buyer?
So firstly, it was this shutdown because the TGA has been, they wanted it at 850 billion, which is high anyway. It's at 900 and something billion. So there's about 100 billion too much in it already versus what they wanted. But they've had to hold it because of the shutdown that's going on that's just ended. So that should start withdrawing. So that's Fed net liquidity going up. We know the balance sheet is also growing. So then, okay, now we've got a tailwind. The next step is the issuance of bonds and bills and who absorbs them. So they've just changed the ESLR, which is the risk weighting on treasuries, reduced it, which means the banks can buy more treasuries. Today, they announced the funding schedule. It looks like, because of how it's structured, i.e. they're not going far out the yield curve, they're keeping to bills, there's about 150 billion of extra liquidity coming from that. The difference is now, because they've changed the regulatory requirements, the banks can do more with that, with those bonds. So they will recycle that capital and create money because the banking system can print money in its own right. So it has a multiplier effect. So that starts really kicking in sort of March, April, May, but we've got the TGA beforehand. Then we got the fiscal stimulus. We've probably got some rate cuts. So it feels like it's all there, but it just needs to happen. Meanwhile, the Chinese are extending their balance sheet. They've been the driver of global liquidity. So that's good. So the conditions are in place. Are we going to get a nuclear bomb of liquidity? I don't know. But I know that the banking system will re-leverage it. The big thing is if Steve Mirren gets through what he wants to do, which is reduce all risk weighting on government bonds for banks. So that means they can really, they can create 5 trillion of leverage. And that's a big deal because A, it goes through to Main Street because they lend money. That gets the ISM screaming higher, the business cycle, recycles capital through the system, finances the CapEx spends that are required for all of this, data center build outs and all of that. But it also creates money, M2, all of that. So I think that's what they're going to try and do. And Scott Bessent knows he has to have liquidity if he wants good markets. And the market's showing you right now that it doesn't have enough liquidity. NASDAQ's been sideways for 2 months now, 3 months. Everything feels a bit heavy. The gold trade is gone now for the time being. And it will never suck in as much capital again. Even if gold takes to new highs, it won't get that amount of attention again, where it sucks in everybody's attention. I mean, you and I know every single crypto trader became a precious metals trader.
That's exactly right. And then also there is this anxiety on, AI CapEx, AI spend. which is further pushing. On one hand, it's further pushing down kind of the risk appetite. On the other hand, it means that someone will look and say, well, I invest a lot in AI. I should probably, go back to crypto a little bit. And, maybe that helps as well.
Yeah, I think so. And I think there's we've tended to see when gold peaks, gold generally is in line with financial conditions, which leads everything. So gold tends to peak and then Bitcoin really tends to perform. Now, it's not a prerequisite, but it's kind of that. What you'd like to see is the ISM going up, liquidity increasing, gold sort of topping out, and that gives you generally what the structure is. Then you want to see what you mentioned before, altcoins starting to stabilize versus the majors. You want to see Bitcoin dominance coming down, all of those signals. So it feels like they're very close to a lot of this right now.
Yeah, and the only thing that's causing anxiety on my side, it feels we've been very close for a while, and then yet every day we're just getting kind of breaks.
It's surprising to get every day the market's down 6%. I mean, it's like, and I've not really figured out who the sellers are of all of this. It's fine to have no marginal liquidity, but who's the seller and why? I don't understand. I mean, there's obviously a lot of players in the market. I hear it's a lot of miners who are switching to data centers, so they're switching use case, and therefore they just liquidate their Bitcoin. Because there seems to be a lot of selling coming from the Middle East and Asia, China, and that's what I hear. But who knows, right? Everyone's got their own theories right now.
Yeah, exactly. And then I don't know. Over the last 24 hours, we have this kind of coordinated push where people are hoping to cause a bank run on Binance, which, well, firstly, I don't think they'll succeed, but secondly, it's not like they're helping anyone. But maybe that is partially it as well. It's just very unclear, and as per usual, we will only know in retrospect. But then everyone has to make decisions today, waiting for an explanation later.
And what do you think for people watching this? You think people should just be closer into the risk curve right now, so stay in the majors and wait for a better signal if you're in the market? I mean, how should people think about it, or should they be broadening out a bit because this is the opportunity set?
It's very hard, right? Because everyone has their own, as a classically trained banker, it all starts with risk tolerance.
That's right.
And allocation. So,
people don't understand risk tolerance until they have a 40%, 50% drawdown.
Well, until they can't sleep, basically. Yeah, exactly. Yeah. So, my personal approach is, okay, how much am I willing to lose, right? So if, let's say, there's an asset that I think in the worst case scenario can go down 80%, and I'm only willing to lose $80, then I should only invest $100 and no more, right? So then if someone has invested already, and obviously most people unfortunately have in our space, then it's very hard. And then the question is, how do you go after or, around that? How do you manage that? And again, just thinking logically, I remember in 2017, I said no to most ICOs because I thought that ETH is like the NASDAQ and all of those things are like small caps trying to outperform it. And I missed out on a lot of winners, but on average, it's been okay. And my thinking hasn't really changed where I feel, we have the benchmark, which could be a basket of ETH BTC Sol, for example, and you can just hold it and go to sleep and know that most likely it's going to be okay in the end with a long enough time horizon. Or you can try to be more active, but then you'll need to realize you need to manage it more actively and you take idiosyncratic risk, right? So you may say that instead of holding, ETH and Sol, you want to hold SUI, for example, for a variety of reasons. And in a specific market environment, it will do phenomenally well versus the other ones. But then you will wake up one day and, it's going to be down more than the majors because it's higher beta. And then you need to be able to ask yourself, why am I still holding this?
That's right.
Keep holding this further. And then if you can't answer why am I still holding it, you will most likely sell at the worst possible time.
Well, because people also confuse why am I holding it with price action.
Exactly.
And, you know, you have to ask yourself, has something changed in my assessment of this? Is it acting in line with where it should be on the risk curve? You know, you look at it, if Bitcoin's down 30%, ETH's going to be down 45, Solana's going to be down 55, SUI will be down 75, right? That's the normal risk curve. Is it doing anything different to that? Is the question you have to ask yourself as well. Or if not, it's just its beta.
Exactly. And then, you know, people would need to spend time thinking about it. Then they need to adjust for the fact that they'll be wrong, let's say 50% out of time, which means you need to run a portfolio and an end, which usually should lead to the conclusion that, you know, just take it easy unless you're highly specialized or, you know, well trained. But that's not how people operate in crypto naturally. So I think it all starts with asking yourself, you know, what are you, like, if whatever you're holding goes down by X, are you willing to, you know, to bear that? And then even maybe more importantly, you know, on the way up, is it likely to make new highs? Or is it going to go down 90% and then double from there, right? Because that's another complexity. And I feel unless we get like a COVID bazooka, then it's reasonable to assume something good to happen to the majors and the quality assets. But, you know, if something hasn't made a new high since 2017, you know, it's like the death spiral. It'll probably make lower lows and lower.
But you know what they're all going to do? They're all going to look at the chart of Zcash and say it's possible. That's what happens, right? You screw your whole thinking because you're like, look at Zcash, this could do it.
And that's the main challenge with the space, because we've seen so many people get wildly, you know, well off on the back of taking very large, very concentrated bets.
Yeah.
Obviously, we see the survivorship bias, right? There's this, you know, Twitter thing, coin fashions, where people like anonymously write their confessions.
Oh yeah.
And you read that, it's like, it's pretty bleak, what people are actually experiencing. So there is this temptation, you know, it's like there's, you know, there's this joke that the worst attack on education came from the Zuckerberg story. Because now everyone thinks if I'm a dropout, I'll be a billionaire. Great. That's not really how it works.
And it's also the survivor bias is, let's say you get a room full of people who've had a good career, they got $1 million in investment portfolio. One guy happened to buy Ethereum at the ICO. He's now a multi-billionaire. There's 10 of them who did other ICOs and they all went to zero. You don't see those stories. You just see the one person who got it right.
Exactly. And that's why, you know, like any, you know, coach or, you know, psychologist will tell you, it's important to look within and understand what you're willing to live with, because ultimately, you know, we'll need to acknowledge that, you know, we might all be wrong and maybe we've just been delusional for 10 years and none of this makes any sense. And like, you need to be able to survive in that scenario. It's very nice to have a story where you go, you know, all in, you know, you're back to the wall and it's a dramatic story of how, you know, you make it. But life is not as dramatic. And, you know, if, I don't remember who's one of the Twitter personas said that, you know, if you don't manage your risk, then the market will manage it for you.
Exactly right. So final question for you. Do you think, is this I know it's a weird question when Bitcoin's down 40% or whatever, but is this a bear market or is this a mid-cycle kind of weird thing? What's your mental framework?
So that's a great question. So we try to think in cycle terms, and then we're looking for a signal that the cycle is broken.
Yeah.
Tell us we're in a different regime. And last 12 months, 13 months now, have been absolutely brutal. And, you know, an average altcoin is down 80%, and the majors are down a lot. But if you actually zoom out and you look at the relevant macro indicators and you look at the majors, it doesn't look broken. It looks like we went through a very sharp correction within the bull market. This correction has then been extended. in both duration and magnitude. But at this point, it doesn't feel right to say that the whole thing is broken and you need to get out because it's going to be 2 years of pain. That may change tomorrow if we go down, at more and more and more and more. But as of right now, it just doesn't feel like stuff has broken.
Yeah, I agree. If you just look at the, like the monthly chart of Ethereum or something like that, it just looks like it's a sideways consolidation since 2021.
Yeah.
And there's nothing scary on that chart. Yeah, when you zoom in, everything looks super scary. But when you zoom out a lot, it's like, it doesn't look that bad at all.
Yeah, and then you have some other names which are either holding very well or are making, higher highs, even in this environment. And then I think we need to take a step back. I had an interesting call from one of my LPs around Christmas, and he's kind of invested on the long side, and he's kind of thinking whether he should increase. And one of his questions was, Evgeny, do you think the industry is going to die? And I'm like, well, why are you even asking that? And he's like, well, when prices are down 80%, that's usually a signal that something is, collapsing. And I was like, well, actually, stable coins, banks, again, blah, 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 blah. And he's like, oh, wow. Because that person is not in the space at all. And he's like, oh, I just looked at the market. I assumed everything is dead. So the question we have to ask ourselves, is ETH worth zero? Is pump worth zero? And if it's not, then we don't know what it is because we can't do a DCF. Not really. But we can have a mental model, right? Can you, if you really believe, well, the data is telling us that, $1 trillion of tokenized assets could exist on Ethereum in the near future. Could the security value of the network be lower than that? Doesn't really make much sense. You can argue both ways, definitely, but it's not unreasonable to assume that this is an opportunity rather than a sign to, abandon all ships.
Yeah, that's how I see it as well. All right, my friend, fascinating conversation. Thank you. Hopefully people have got a lot out of this, and let's see where we go from here. I mean, I remain bullish. It was a pretty shitty year last year, but it is what it is. And I think it's, as you and I spent a lot of time talking about, you've got to have the right mindset and understand what risk you're taking and what your actual risk tolerance is. I mean, those of us, the longer we've been in this game, the more risk tolerance you have. You have the ability to take absurd risks. I mean, I've had 2 87% drawdowns in Bitcoin alone, and I'm having a decent sized drawdown in Sui right now. Well, drawdown from peak, I'm still up on the trade. But yeah, I mean, this is how it goes. And it's not an easy game, which is why there are big returns when it works, because it's not bloody easy.
That's exactly right. And yeah, let's see where we are tomorrow.
All right, my friend. Good to see you.
Thank you all.
So let's see how the market develops. I think the opportunity set remains as is, and that things will continue back on the normal path. And a lot of this noise in markets will be just that, noise. Anyway, I'll see you next time. Good luck out there. Today's episode is brought to you by Abra. Abra aims to provide individuals and institutions with a secure way to control, manage, and grow digital asset wealth from a separately managed account. Abra helps its clients get exposure to crypto and crypto financial products like yield and lending through one full service platform. If you're looking to gain access to additional liquidity, Abra has one of the most competitive loan products in the market. You can borrow against Bitcoin, ETH, and Solana at up to 50% loan to value. Rates are in the 4 to 6% APY and are open term. You can continuously draw down against your collateral as the price appreciates. Abra has other strategies to add yield, and their team is happy to help align your portfolio to your risk profile. Reach out today and get a complimentary consult on your portfolio. It's worth seeing if they can help you manage your allocation, reach investment goals, manage risk, and add additional yield. Go to realvision.com/Abra and tell them I sent you. So, you obviously like this video enough that you've got to the end. That's quite a big task. But listen, do me a favor, hit the like and subscribe button, and also check out what video's next, because I think you'll love it. But if you want even more, and when I'm talking more, I'm talking about member-generated ideas, incredible alpha, research,
Everything there to help you in your journey. Just head to realvision.com/join for the best financial intelligence out there and the pure alpha that's within the platform.